Everybody. I am Eric Arndt. I know some of you I don't. I am the 401k advisor for General Networks for several years now, and I'm having a lot of fun. I really like the team there. I'm also the personal wealth advisor to many of the employees, and I've enjoyed that as well. Today, we are only talking about one thing, the Mirror 401k, and I'm going to explain what that is and how it works for you, and then what we would do to move forward. So today's agenda is, what is a 409A non-qualified deferred compensation employer-sponsored retirement plan? So maybe you know now why I call it the Mirror 401k. It's a little bit easier to say that. I also want to explain how it works, what's in it for you, okay? And then I want to explain strategies for you on what this does to help you prepare for your own individual retirement goals, okay? So the first thing is the term non-qualified plan. People want to know, well, what does that even mean? I want to make sure I covered it. There is not going to be a test, but it is important to know. Tax deferred. So this 409A is a tax deferred employer-sponsored retirement plan, just like a 401k. It's intended, this is a little bit different, it's intended to cover the highly compensated employees within an organization. Now, it's not an elitist retirement plan, it's just the features of it are more in line with people that earn higher than average income. And I'll explain that in a little bit. It's to be used in supplement to a retirement plan like a 401k. It's not any better or worse. It's a sidecar. Oh, let me let a couple more people in. Okay. And it's very flexible, as you're going to learn about it right here. Okay, so the Mirror 401k solves a specific problem. High earners need to contribute more money for retirement in order to retire with the same standard of living. So everybody needs to prepare for retirement, and most people want to have as much income or more when they retire. Most people surveyed say, no, I don't want to live on 50% of what I used to make. I basically want to live on what I was making. Okay. Now, if that's true, and if that's you, then you need to put away more money than average. Okay. So someone, for example, someone making $75,000 a year needs to put away at least $7,500 a year. Somebody that earns $200,000 needs to contribute $20,000 or more per year. As you can see, it's a 10% to 15% number. Now, 10% is the minimum for everybody, because if you're not contributing 10%, I can promise you that you are falling behind in retirement planning. I would highly recommend that you contribute 15% of your income. And when you look at that, then you'll see your retirement numbers start to get really clear and you get on track. And if you need to put away, if you are going to put away 15%, the 401k typically doesn't allow you to contribute enough money per year to be on track for your retirement goals. That's why plans like this, that's why the Mirror 401k exists. It's a highly specialized plan. It's different than a 401k, but it's not better than a 401k. Okay, so come on, here we go. How does it work? Okay, the first thing people want to know about are deferrals. Okay, deferrals are your contributions. So you can defer. Hopefully you're making notes. You can defer, you can contribute salary, bonus, any income you're getting from General Networks, you can contribute to the plan, either on a percentage basis or a fixed amount basis. So for example, if you're earning $150,000, you can say, I want to contribute 5%. or $1,000 per month. And it's all before tax. There are no statutory limits on the amount you can defer. I want to make sure this is clear. Unlike a 401k that the federal government tells you you can only contribute $20,500 or $22,500, the mirror 401k, there is no upper limit. I have clients right now that are contributing $100,000 a year and more to a mirror 401k and taking a full 100% tax deduction on that contribution. If you live in the great state of California, if you're able to deduct $100,000 per year, and you get to keep the money, by the way, and the money gets invested for you, that's a significant advantage, okay? Obviously, participation in this plan is voluntary. Okay, the IRS has very specific rules regarding the timing of your deferral. It works a little bit different, and I'm going to explain that in a couple of minutes how it works, but it's not, you can't make changes to your elections week to week like you can with a 401k. Okay, and then elections are here. Great. How does it work? So your investment options. It works just like a regular 401k. I will build you a beautiful lineup of mutual funds. We can mirror the 401k, meaning we can do the same. We can do a little bit different of a lineup than what you're using in the 401k now. And then you can reallocate whenever you want. You have access to your account, you make changes, and then you log out. It's that simple. Okay, so how does it work? Plan distributions. Okay, this is an important one. Plan distribution, this is where it's different. There are 6 permissible payment events when it comes to a plan like this. Separation from service. Obviously, if you leave General Networks, you take your money. Unfortunately, if you die, you don't take your money, but your heirs do. If you become disabled, if there's a change in control, meaning GNC sells to Microsoft, then you have the right to take your money and leave. Or if there's an unforeseeable emergency. And the last one, which is really interesting, is a specified date or age. And I'm going to get into that also in a minute, but think about this. Sometimes clients will ask me, well, Eric, I don't want to wait until 59 and a half. I want to retire earlier. Great. The mirror 401k, you can take your money out without any penalty that a 401k would have. So if you take your money early in a 401k, you'll get charged a 10% penalty for what you take out. The other reason people do this is they say, well, in 5 or 6 years, I need a bunch of money for my child's education, or because I want to buy a Ferrari, or I want to buy a vacation, or I want to go on vacation, or I want to buy a boat, which is a bad financial decision, but people want to do it. So that you can just schedule that in, you take your money, there's no penalty. Okay, payments can be scheduled in a lump sum or in a number of installments. Okay, that will be explained also, but just it's very flexible. That's what you need to know. Okay, now how are they similar? So a 401k and a 409A have overlap. There's similarities to it. Now, a 409A, for clarity, a 409A is a mirror 401k. I only use mirror 401k because most people, when they see 409A, they think of a cleaning solution, or they get, that's IRS tax code. And that's actually what it is. It's IRS tax code, just like a 401k is IRA tax code. That's why they call it a 409A. Okay, so how is it similar? It's pre-tax contributions and tax-deferred growth. What that means is you contribute money, You take a tax deduction for that calendar year of the amount you contribute, and then your money grows and grows and grows and grows over time. And you never pay tax as long as the money is in the plan. You don't get a tax bill at the end of the year. It grows tax deferred. Investment choices, we talked about that. It can be like the 401k or it can be a different lineup, but it's the same idea. You pick mutual funds. You can have matching contributions, just like a 401k. Just like a 401k withdrawals, the money you take out is taxed as ordinary income in the tax year and the state in which you reside. So you can read between the lines on that. I have had clients that say, well, Eric, what if I retire to a low cost a low tax state like Nevada? And I say, well, that's between you and Nevada, right? That's when you take the money, that's when it's taxed. And then the plan sponsors typically pay the cost of plan administration. That's how they're similar, okay? Here's how a 409A is different than a 401k. There are no limits to the amount of deferrals. Like I said, the government does not get involved here. You can contribute as much as you want. Now, this point is also different. Benefits, meaning the money in the 409A, is not protected from corporate bankruptcy or insolvency. That's different than a 401k. So if GNC files bankruptcy, that's an asset of the company. So it could be part of insolvency, okay? The footnote I want to provide you with this is I have a bunch of these plans set up. In the state of California, there is bankruptcy case law that shows bankruptcy judges do not allow creditors to get at the assets of a 409A. So there is protection in the state of California and other states as well, but specifically California, because it is so employee centric. Okay, I can't imagine a bankruptcy judge ruling against employees in favor of a creditor. But I want to make sure that we're clear on that. Any questions? We can talk about that in a minute. Distributions can be taken earlier than 59.5 without penalty. The 409A is open to top management or highly compensated people. That's who it benefits. It doesn't benefit your standard employee, who's making $75,000 a year, because they can just use their 401k. Okay, it works just fine for them. Plan benefits cannot be rolled into an IRA. You'll take that money as income when you take it out. Okay, loans are not allowed. They're allowed in a 401k. They're not allowed in a 409A. A trust is not required. And the investment options serve as a benchmark. So that's sort of a technical term there. Okay, let's keep moving. So let's see, that's the next steps. So that's how the 409A works. I mean, I can go on and on and on, but I want to make sure it's clear that how does it work? How does it work like a 401k, and how does it differ from a 401k? Now, these are the next steps. Todd wants a minimum of 6 employees participating in the plan to make it cost effective for General Networks. Okay, I think that's reasonable. So if you're interested in participating, you'll want to let Herb know right away. Okay, and if we can get 6 or more, I think we're going to move forward. Okay, General Networks has generously agreed to pay the annual administration cost for the plan. That only leaves the account fee, your individual account fee, and that's about $100 per year. Okay, and I think that's obviously very reasonable. And if you guys decide, yes, we like this, sounds good, I want to make sure you know it's about 60 days from the yes decision. and then I will do an enrollment meeting and explain to everybody how it works, how to get in, how to enroll, what the portal is, how to use it. We'll do a full enrollment meeting, and then you will have online access, just like your 401k, and it's a beautiful, beautiful thing. Okay, now we can do some Q&A. These are the most common questions I get when I do a Q&A for a 409A, but I am obviously open to any of your questions. So I will open the floor. You can unmute yourself and we'll do a Q&A there. If I don't get any questions, I'll just review my questions here.
Hey, Eric, Jonathan. Can we adjust the amounts, the percentages going into the 409A?
No.
So you pick once and then it's done?
That's right. So right before the plan opens up for re-enrollment, so every year you will re-enroll. Unlike a 401k where you kind of set it and forget it, each year you re-enroll in the 409A.
Oh, so every year you can change it?
Correct. And then,
okay.
For example, you'll say, I want to contribute, 10% of my base salary and then $500 of my bonus. And then that will be what you're committed to for that year.
Got it. Okay, thanks.
Good question. Thanks, pal.
Can you, Eric, can you funnel what you are currently doing in a 401k straight into the mirror without funding the 401k first?
So just the 409A and not the 401k?
Correct.
Oh, yes, absolutely.
And you can also do 10% or let's say $1,000 to the 401k and whatever else you want to the 409.
Correct.
Can you just do 409A?
Correct. Yes.
Is there any reason you would not want to do that? You'd want to max out the 401k first, then do the 409A?
To get the match, right? The 2-3%
Yeah,
match.
A good point.
That's a good point. The match. Mm-hmm.
And if you wanted to go into a Roth, which is, post-tax, but no taxes later, that would be another reason. That and the match. Those are the two items.
That's right.
There is no Roth involved in 409A. It is all
Correct.
specifically pre-tax.
It's also, even though it's a relatively unlikely thing that GNC would have financial trouble, but you know what, things happen. The 401k is 100% protected. There's no question about it. No matter what happens to GNC, because it actually leaves the company. But the 409a, the money doesn't leave the company, and so it's something that you have to be. It's out. It kind of does, but theoretically, as Eric mentioned, in a bankruptcy proceeding, you're going to be competing against other creditors. So my advice would be max out your 401k first. I can't think of any reason why you wouldn't. Can you think of anything, Eric, why that a person would say, no, I don't want to do the 401k at all. I'm just going to go straight to the 409a.
Well, sure. I mean, if someone wants to defer salary, so here's an example. You're making $200,000 this year, and you say, boy, I have a big expense coming up in 6 years, but I'm not going to be retired, right? I can't take it out of my 401k. I just want to get it out of my tax liability for 2023. So you contribute $30,000 to the 409a, you'll only pay income tax on 170. And then in 6 years, when you want, you can take that 30,000 plus interest, or 10,000 of the 30,000 earlier than 59.5.
Yeah, understood.
Right. And here's another thing. It's not just 59.5, right? It's whether you're going to be employed with the company and 59.5. So it's, questions like that. I can talk all day long about different scenarios that I've worked with clients, but those are like on an individual basis. I'm happy to give you a one-on-one consultation in private where I can talk about your situation and we can figure out what is in your best interest.
Cool.
It's sort of like, I'm talking to a carpenter and I say, well, why do you need that Phillips head screwdriver? Just, a hammer is so good. He said, well, I need both tools, right? And that's what it comes down to. I want to help you guys understand both tools and how to use those strategies so you can explode your wealth long term.
So you mentioned two ways that you could extract the money, right? One is, or multiple ways, but the ones that I'm remembering, like a date or a schedule of the withdrawals, right, over time. You just mentioned an example of, in 6 years, I need 30K, and so therefore I would schedule that date for 6 years from now, right? Once you've scheduled that first sort of extraction of money, do you then need to extract it all, or can you leave a portion there and then have another date without actually having a schedule in place? Does that make sense?
It does make sense. Eric, that's a well thought out question. It must be because your name is Eric. So good question, my man. No, you don't. So let's just say in that situation, in 6 years, you want to take out 30,000. That's it. You don't ever need to take out any more. And then in 3 more years, you can set up another schedule to take out more money in 3 more years, or you can never set up another schedule. It's really flexible like that. Now, what is different about withdrawals is it's not a, hey, I want to take out money next month. You can't do that. You must schedule a year out. Okay, so you need to schedule it in the future. It's not because I met somebody who's really amazing and I want to buy them something big in a week. This is not that flexible. Okay, but the answer to your question is no, you don't need to start taking any more money after that initial withdrawal.
Eric, do you want to compare this to the college fund where that's post-tax? Any comparison to that?
Yeah, sure. So you have the 529 employer-sponsored plan at General Networks. That is only for education. So you'll contribute money after tax to a fund, to an investment account, and that money will grow tax-free as long as you use it for college savings. So I think what Herb is saying is, can you compare the two? So if I'm making 200,000, I will pay tax using the 529 plan. I will pay tax on the full 200,000, and then I'll contribute after tax money to the 529. And then that money will grow, and I'll take it out for my child's education in 6 years. The 409A, I will fully deduct my contribution, meaning I will set aside a separate bucket called my son's college fund, $30,000 for this year, or split it between my son and my daughter, and that will be fully deductible in the current calendar year. And then down the road, when you take it out, it will become taxable.
Okay,
Eric, you said when we leave the company, we have to take the money out. Is that the case?
Yes, and you would want to, right? I mean, that would make sense.
So you would incur that income in that calendar year that you left the company.
That's right.
So if I retire in 7 or 8 years and I'm out of the company at that point, then I would have to take the full distribution at that point.
You can actually schedule it in tranches, so you could take it in 5 payments if you wanted to. And the reason we do that is to lower your tax liability, right?
Right. Yeah.
So again, let's say you build up 250,000 in the 409A. I actually just had a meeting on this with a participant on Monday, and he's built up quite a bit in the 409A, and we're going to schedule it over 5 years. So he'll pay minimal tax in retirement, much, much less than had he done that during his earning years.
Got it. Okay. Thanks.
So it worked out really well for him.
So even at the time of separation from the company, you cannot roll it into anything.
Correct.
I'm still confused, Eric, about when you can take the money out. So if you say, oh, I'm going to take the money out in, when I'm 58, but then it turns out I want to take the money when I'm 56, could I do that or no?
You can, as long as you put in enough notice that you're making the change. So I think it's 1 year in advance. Let's say when you're 55, you decided I'm out of here next year, you can change your 58 to 56. But you can't, when you're 56, say, I'm changing my mind to 56.
I see.
So as long as you give the proper notice, you're fine. And what's really neat about this plan is we send out a notice to you and the plan administrators to say, hey, Eric wanted is scheduled to take out funds in a year. At this point, he can still make a change to that. Yeah. And then Eric is, oh my gosh, I forgot about that. I'm not going to buy the Ferrari just yet. I'm going to wait another year. So you can change that.
So if you put your money there for retirement,
Mhm.
and then you retire from the company, can you get it, schedule it so that it is coming to you over the course of the next 20 years? Or can you only do it over 5 years?
5 years is the max.
Whereas if you have a 401k, it'll pay out to you for a long time.
Correct. You can withdraw it on any schedule. Correct.
What protects the money? If, say, for instance, the GNC is having a rough year and Todd needs to fill some gaps. Can Todd take from this money to fill some gaps to bridge us for a year?
PJ?
Yeah.
That's a really good question. Okay, let's dig into that.
How dare you?
It doesn't mean I don't trust him.
No, I like this. This is a very open, honest group.
You might understand, Eric, that I know PJ very well. So. I repeat, PJ, how dare you?
He knows you very, very well. Okay, so Todd's not listening, so we can just talk. The money cannot be used for any other reason. In fact, we can set up something called a rabbi trust, RABBI, just like it sounds. And it was set up for a rabbi many years ago. And the rabbi trust protects the money to only be used for the participants of the 409A. It would be a crime, embezzlement, for the company to use it for any other reason. And that's something that I would recommend. You don't have to do it, but it does make the participants feel really good about it.
So we got to watch Todd carefully, is what you're saying.
I would yeah.
Yeah, I think probably what we do, and if we do this, it would probably affect me as well. Probably what we end up doing is just trying to first of all, we probably do some internal policy things that we have the board pass to try to put all these things in stone. I think the real danger, so we'll put all the walls around that we can. The real danger is really just bankruptcy, and I don't know. I guess I'm not supposed to make forward-looking statements, but we run pretty carefully here. I think the odds of that are pretty low.
Yeah. And just to follow up on that, thank you, Todd, for that clarity and just the general direct and transparency on this. I love it. But the two things you want to be thinking about is, like Todd mentioned, the the bankruptcy. That's a big one. And as I mentioned before, you can quickly Google this, the employee's money in a non-deferred comp being protected in a bankruptcy. There's case law already on the books. The second thing you want to be thinking about is, well, what if Microsoft buys us? Now they have control. Keep in mind that that change of control allows you to get access to your money ASAP. So if you're not comfortable with this purchaser, your money is yours. So there's not really a concern on that either.
Eric, I'm in Florida, so I know you talked about California case law. I assume because the company's in California, the protections are still there. I don't know if there's any difference for that, given that I'm in Florida.
Oh, boy, it's even better. So
Would
yeah,
California just say, we don't care about people in Florida, you can have her money?
no, so the company's domiciled in California, you'll get California case law in regards to the bankruptcy, but tax-wise, you'll pay tax down the road for Florida.
Yeah.
So yeah, that's a beautiful thing you got going on.
Quick question. Well, maybe quick. Is with this different program, is there any kind of balancing that occurs? We had something happen, I think it was last year with the 401k program that because we didn't have enough people contributing or enough lower earning people contributing, some of us got some of our 401k
Great.
contributions retracted because they had to balance like how much everyone was contributing across the company. I'm sorry, that's kind of vague. Hopefully you know what I'm talking about, but is that a factor with the 409A?
Great, really good question, Ingrid. So let's take a step back. With a 401k, because of the way it's the oversight, there is testing on a 401k by the federal government. And the reason they test a 401k is because they want to make sure that a company is not putting in a 401k to only benefit the top people. So they test a 401k to make sure everybody's participating. If you fail the annual testing, which is what's happened to general networks, some people get a refund of what they've contributed because they've over contributed based on the requirements set up by the federal government. So for instance, in a situation, a company fails a test, and the testing company says, you can only contribute, the maximum amount you contribute in this 401k is 7%. Even though the federal guidelines are 22,500, your plan is failing, so you can max out at 7%. That's why you're getting a refund. Now, that's what starts the conversation for me with a 409A for a client. And I say, you don't have that with a 409A. And then a client will say, are you kidding? How do we not know about this? And I'll say, well, we know about it now. So there is no annual testing on a 409A. That's why you're able to contribute whatever you want per calendar year. Does that answer your question?
It does, yes.
All
Thank
right.
you.
Great question. Love it.
Eric, can I ask a follow-on question to that? So in the instance where you do get a refund because of what you just described, can you put it into the 409A as opposed to getting it refunded?
Technically, no, because you're getting it for the past year. So let's say in January of 23, you get that refund for 22.
Mm-hmm.
22's already happened. You can't contribute that to the 409A because the 409A contributions were decided in December of 21.
Okay.
Makes sense? So it's like you could get that $4,000 back and say, okay, for the next enrollment meeting on the 409A, I'm going to put that in there and then get that tax deduction. But it's not the same money.
Mhm.
You follow? It's sort of like
Yep.
6, 1/2 dozen the other. Okay.
Got it.
Eric, do you have the powers to predict whether we're going to fail the test again?
Are you good? Wait, is
The
general?
401k test thing that caused the rebates.
So what happens is participants usually start to contribute less and less each year because they know they're going to get that refund. So I don't know. Herb, you want to jump in on that? Did you guys fail in 20?
Part of it is it depends on salaries. It depends on what people contribute. Honestly, PJ, we don't know. Frankly, there's been a lot of years it's happened. There's been some that it hasn't, but yeah, to be honest, I don't see any way we could predict that. Sorry. There's just no way. It depends on what people contribute. And some people, put money in and, change the beauty of the 401 is you can change your deductions literally weekly. And I get those notices. So I see people doing that. So yeah, I could not predict that, to be honest.
So maybe this might help. Thanks, Herb. This might help in planning. You want to look at your tax situation. And again, let's use the example of 200,000. Maybe you have a household income of 350 and decide I'm fed up with paying 45% of my money in tax. And then you decide I'm going to allocate that 30,000 to the 409A. And then you're going to safely contribute to the 401k. And the reason it's safely is because we really don't know until the end of the year if you're going to fail, right? So maybe you want to sort of rule of thumb, I don't know, her, maybe we can figure this out, like a 6 or a 7% contribution is safe, quote unquote, to put in the 401k. And then everything after that is probably a 409A contribution.
That's that number seems low to me, but it really, the people who got the refunds, you in theory should be able to figure, oh yeah, it was this much. So that makes it kind of that percent of what I'm allowed to put in, and maybe figure from that if it was, 2 or 3%, from the 20 below, from the 22,500, then you could go, okay, so I'm only going to put, 20,000 in, and then the rest could go to the 409A. That'd be the only way I could do it. I honestly, I don't see any way we can accurately predict. It's just because it all depends what people make, what they contribute. And that's really so that changes, the way, especially the way we get paid, it fluctuates. So that's very difficult to predict.
Right. So thank you, Herb. So to make this clear, or maybe a little bit more clear, when a 401k, like General Networks, fails testing or alternate years continuously fails testing, it unfairly penalizes higher earners, right? Because they can't contribute enough for their individual retirement goals. So they're forced to pay tax on most of their income. Now they're left with after-tax money to invest. So that's why the 409A is set up. So for example, if a household income is 300,000, you should be contributing at least 15% each. So that's 15, you're at $75,000 to $90,000 of household income pre-tax to retirement. You can't do that in a 401k, even if you're not failing a test.
Right. Yeah. Even if you can't, right, you're still at the 22.5. That's correct.
Right.
Or a little more if you're over, 50.
Right. If you're lucky enough. Yep.
I think it went up to 30,000 this year, didn't it, for the over 50s?
It did. So some of the questions I get is, why haven't I heard of a 409A? I don't know, but it's a very, very popular plan in the Fortune 500. I think almost every single company in the Fortune 500 has one. We have one. Many of our clients, large companies have them. Very, very popular for the employee and the employer. Employer uses it as an amazing recruiting tool, especially in a small and mid-sized business like General Networks. Not many of your competitors offer it, very few. So you can use it as a recruiting tool, and you can, and for the employees, obviously it's a major benefit tax-wise, especially when you live in a high tax state like California. So maybe that helps clarify some of the other questions that are out there.
Eric, one more question. Through Googling, it appears that there is a risk of this type of plan, if it is not being administered properly, to lose its tax deferred status. How can we feel confident it will be administered properly according to the rules?
Oh, PJ, were you on Google doing some research?
Always.
Love it, love it. Okay, thank you. That's a great question. The company we will use, or we can use, is it's an absolute expert and one of the elite administration companies for 409As, and you'll get a chance to meet them. This is all they do every day. They don't offer any other services than this, and they're experts in it, and they've been doing it for decades.
Thanks.
I suppose just thinking about that one, PJ, what we'd probably do is have because I don't think there's any reason particularly not to. What we'd have probably do is have the 401k committee just expand to become the 401k/409A committee, and have them select, or do whatever due diligence they want to do about this kind of thing.
Yeah, that's an idea. Yeah.
Yeah, that is a good idea. But that's a very good idea. And yeah, the companies that we will use to make this happen, again, decades of experience, experts in the space. They do it for very large companies. We have relationships with, they will do it for General Networks. It's that simple.
Come on, PJ, what else you got?
I think PJ's typing away on
For Google's fault.
Yeah, Ingrid as well.
Yeah, that was my only question, was about the balancing. So
Oh, okay.
yeah, thank you.
You're welcome. Thank you for the engagement. It really makes the enrollment meeting helpful for everybody. So thank you.
Can you expound on what unforeseen emergency examples are?
Yeah, that's a lot of flexibility, right? That's when the employer can decide what the guidelines are.
You mean the plan administrator that has years of experience and only been doing it, right?
I'm sorry, the plan administrator.
Well, it seems like it shouldn't be a decision the employer gets to make of who decides what an emergency is, right? Because then that puts the plan at risk and its tax shelter at risk.
No, I mean, the plan administration company will guide the employer, but it does give them some flexibility. So, I mean, maybe not every unforeseen emergency, that's why we call it unforeseen, right? We don't know, but if something does pop up, there is some leeway, but it's the standard stuff. I mean, sickness, illness in the family, house, lose a house, it's all of those emergencies that you would think about.
Yeah, it won't be, I got to get Taylor Swift tickets.
Whoa.
Well, I don't know, for some people that might be an emergency, but I don't think that'd be covered.
Just me and you, Herb.
Not me, definitely not me.
Oh, great. I'm getting some good feedback here in the chat. That's great. Well, guys, you have my contact information. Obviously, there's no need to hang on. I'm here for you whenever you want. Talk more about it. But this was a great session. I'm going to go ahead and I recorded it, and I will get it approved and sent it out to Herb, and then he can disseminate it from there.
Correct. Yeah, thanks, everybody. And if you have more questions, ask me or ask Eric, or, that way, think of things after, ask away.
And then Herb, when is your sort of deadline on getting 6 people that want to join?
I don't have a date, obviously, I've already got a couple of yeses. So,
Well, let's just pick a date, I guess.
Yeah, that's,
There's probably no reason to wait very long. Why don't we just make it, we'll make it March 1st.
March 1st.
Like it.
For me.
If
Yeah.
there's some reason we need to extend it, just let us know. But otherwise, we have to go back to the board and essentially ask them
That's
to.
the other thing, correct. We need to get the board approval on that. But,
Right.
Yeah, so a week from today,
Right. So that would give us a May 1, right?
May 1 start, 60 days.
Yeah.
Well, if we get the board together, that'll take, a few days from there. So,
Okay. I mean, just, yeah, rough numbers. Yeah.
cool.
Thank you, Eric.
Thanks, everybody.
Thanks, Eric. Thanks, everybody.
Thank you, Eric.
Thanks, Eric.
You're welcome. Thanks for coming.
Well.
Take care.